Alright, today is Tuesday, February 16th, and this is a post-market review and an analysis for the stock market activities today. The energy crisis deepens in the country, specifically after the snowstorms and the freezing temperatures heading across the United States, but specifically in the state of Texas, leading to a massive surge of inflation expectations, and that in turn leading Treasury yields to skyrocket higher. We have moved from 1.2 on the 10-year Treasury yield to 1.3 in a single day, and the trajectory here for yields to continue to rise and skyrocket higher and higher as more information come out supporting the thesis that we are heading to extreme levels of inflation. Meanwhile, the Federal Reserve continues to be in denial, and they have released their propaganda machine today to try to tame down inflation expectations. However, so far, they have been doing so unsuccessfully. We will cover all of that and a lot more during the headlines of the day's segment. We have a long video ahead of us, so let's not waste any time and let's cover the market already. And here we go. The Dow Industrial Average closing in the green by 64.35 points, or a gain of 0.20%. The Nasdaq in the red, down by 47.97 points, or a decline of 0.34%. The S&P 500 in the red, down by 2.24 points, or a decline of 0.06%. And what about the sector's performance for the day? Energy, we know the energy crisis is going on and prices are skyrocketing, and therefore energy, the top performer for the day and capturing the gold medal. And at number 2, capturing the silver, financials, the rise in inflation expectations will lead to a rise in Treasury yields. In turn, that would be very good for the financial sector. Understand that the rise of inflation is not a death sentence for the market overall, but it is a death sentence for the overvalued pockets in the market. And here it is at number 3, capturing the bronze, basic materials. And once again, when we see a decline in the US dollar and a surge in inflation expectations, we see an outperformance for metals, specifically copper. It was a big day for copper prices today. Meanwhile, the laggards of the day led by healthcare, utilities, and real estate. Shifting to the futures market performance for the day, what do we see here? Crude oil surging higher. But the story here is natural gas. Massive move higher, and we will cover the prices in Texas. Some of them are just unbelievable prices, but it is a state of desperation right now in the state of Texas with a deep freeze. What's going on with softs? The laggards are led by coca. That's the only decliner in softs futures, but we saw gains in OJ, cotton, coffee, lumber, and sugar. What about metals? Sizable gains for copper, platinum, while we saw modest gains for palladium. Meanwhile, the laggard of the day in metals futures, gold declining significantly. And the story here for gold, there is an exogenous factor. You would think that gold would outperform during high inflation expectations, but that is now put on hold, and we're actually seeing a massive outflow from gold due to the rise of Bitcoin. What's going on with meats futures? The surge in lean hogs futures goes on and on and on, no stopping sign. Similarly, we saw gains for live cattle and feeder cattle futures. What about grains? Any relief there? Not at all. Inflation is choking the average American household because the rise in grains futures is in turn leading to a massive inflation in food prices. Today we saw another massive rally for soybean oil, corn, wheat, soybeans, oats, canola, all closing in the green. Meanwhile, we saw muted activities for soybean meal futures, even though closing in the green. The laggard here, rough rice futures closing in the red. And what about the big casino, the options market? The hottest table for the day per usual, Apple at 1.3 million contracts. About 70% of those were calls. And at number 2, Palantir. Palantir reported earnings in the morning, and the name declined significantly, over 12.5%. And of course, this is one of the Reddit crowd's favorite names, and they continue to gamble on this name. The growth of the company is decent, but it is not worth anywhere near where the stock is trading right now. And we saw that the CEO of Palantir a few days ago dumped over $70 million worth of shares. Meanwhile, the donkeys, The Robin Hoodiots who continue to chase this name are now holding the bag, and they're hoping to stampede once again to rescue themselves and create another gamma squeeze. But there are also other players in the market who are seeing a wounded animal in Palantir, and they're buying puts to capture more gains on the downside for Palantir. Anyways, today we saw over 1.1 million contracts exchanging hands for this name. About 53% of those were calls. And at number 3, Neo, with a little over 750,000 contracts. About 82% of those were calls. What about the unusual activities that took place in the options market today? The action was very muted. The casino was a little slower than usual. We have a short trading week, and perhaps that is the reason behind the muted activities we saw in the options market today. Yet we have some trades for you, starting with Snap. This is for Snapchat, and somebody's opening a bearish spread here by buying the 59 puts, expiration date February 26, with expectation that the name is going to decline over 6% by then, and they are paying about $1.10 a piece to enter this trade. Meanwhile, they're also selling the 56 puts, expiration date February 26, and they are capturing about 60 cents from selling those puts, and that brings down the entry cost for this trade to about 50 cents a piece, for a total of about $875,000 invested in this single trade. Here's a trade for the ticker MRO, Marathon Oil Corporation. We saw massive gains for energy today, and somebody's playing catching a top by buying the $9 puts, expiration date February 26, with expectation that the name is going to decline over 5.5% by then, and they are paying about 30 cents a piece to enter this trade. That brings the total all the way to about $500,000. And what about this trade for the ticker LQD? This is for the investment grade corporate bond ETF. Somebody's making a bearish bet here, buying the 125 puts, expiration date April 16th, with expectation that the LQD will decline over 6.5% by then, and they are paying about 45 cents a piece to enter this trade, and that brings the total all the way to a little over $500,000. Lots of gambling activities going on in the market right now with small amounts, so we're not going to cover any of those. But here's a notable one for the ticker CCIV. This is for Churchill Capital, a SPAC, and of course it has been rumored that Lucid Motor will merge with this particular SPAC for their public IPO. And they continue to bid this name higher and higher and higher, even though for now it is just an empty shell company. And in this case, somebody's making a bearish bet here that the name is rallying too fast and too hard with no solid news, verified news whatsoever. And they're buying the 45 puts, expiration date February 19th, meaning this upcoming Friday. So they have about 3 days for this trade to work. And the expectation here is that Churchill Capital will decline over 14.5% by then. Of course, that would only happen if we have a confirmation that Lucid Motor is not going public via a merger with Churchill Capital. Anyways, they paid about $2.15 a piece to enter this trade. That brought the total all the way to a little over $1.5 million. And moving on to the headlines that shape the day, starting with macro news. We received data regarding retail sales, and they continue to trend lower, and now the reading is at the lowest since September 2020. So we are witnessing weakness in consumer spending, and the reason is people are afraid to spend. I showed you data from the earnings of Visa and American Express and the likes of consumers being very cautious of using credit cards and tapering down spending on things they don't need. We're seeing the savings rate going higher, and of course, we're only seeing a surge in spending right after passing the stimulus. The first round, the second round, we saw a little bit of a surge, but that died off quickly. And now we're waiting for the third round of stimulus, and that will be spent right away, or going to saving, or going to pay credit cards. And what is the point here? Wasting all of that money, it's not going to do anything to help the economy. It's better off used to support the people who need it the most. People who are waiting in food lines and being threatened with evictions. On the other hand, cutting checks for people who don't need the money to begin with will only contribute to a rising inflation, and that will end up hurting the poor and the middle class the most. And here it is, almost 40% of people out of work have been unemployed for 27 weeks or longer, a dangerous signal of potentially permanent scarring for those workers. And of course, we covered the bullshit data that were received from the Bureau of Labor Statistics regarding the unemployment rate at about 6%. And then the Fed retracted and said, oh, the actual unemployment rate is closer to 10%. Well, we know that the real number is much, much higher than 10%, and the reason is the lack of labor force participation and permanent unemployment surging higher. People are giving up, the economy remains shut down for the most part due to the virus, and companies are not hiring anymore. All of that money the Fed is printing is not going into creating jobs, and therefore people are preferring to sit at home and collect government checks instead. And speaking of government checks, here it is. US now leading in fiscal aid as percentage of GDP. With new measures, US government will redistribute a quarter of GDP in a span of 2 years, dwarfs the amount seen during the global financial crisis. And of course, we are spending more than any country in the planet. We have failed to contain the virus, and the policy to lead the recovery was flawed to begin with. The Federal Reserve decided to usher the tsunami of liquidity, showering Wall Street, corporations, and the richest people in this country with free cash printed out of thin air, which will be added as a burden for the next generation of Americans. Trillions and trillions of dollars, and they still fail to recover the employment picture in the economy and stimulate any positive inflation. In contrary, they've actually stimulated negative inflation, meaning that prices went higher while wages remain low and the unemployment rate remains higher. This is a perfect recipe for stagflation, which we have not seen since the 1970s. And here it is, inflation is skyrocketing by the day. Every single day we're getting another new piece of data supporting the fact that inflation is skyrocketing higher. This is all, by the way, a result of the failed policy from the federal government and the Federal Reserve in tackling the COVID-19 crisis. Rising inflation and commodities prices, and food prices in particular, will be destructive to the poor and the middle class. The average American household is being choked to death. Meanwhile, the Federal Reserve remains in denial. Here it is. There are signs that food inflation is going to get worse. Farmers are getting squeezed by the highest corn and soybean prices in 7 years, which has lifted the costs of feeding their herds by 30% or more. If the input prices increase for farmers, they will pass that to the end customer, leading to a massive inflation in food prices. Here is more. Even CEOs are starting to sound the alarm. Here is the CEO of Kraft Heinz saying that he is concerned about inflation, indicating that food prices may rise in some categories, including mac and cheese and mayonnaise this year. Of course, the average American household has been reduced to eating packaged mac and cheese for dinner, and even that is about to get more expensive. What about the inflation in commodities prices? Copper at the highest prices since 2012 as global equities extend gains. There is a risk-on mood across the whole market, whether it be oil, equities, or metals. It's one of those markets where even bad news is good news. Copper climbed to the highest level since 2012 as risk-on mood across global markets helped lift equities and put pressure on the US dollar. Prices have soared on optimism that the use of coronavirus vaccines will aid a rebound in global growth. Copper climbed 5.3% last week on the London Metal Exchange, in the biggest gain since July. The metals used in pipes and wires edged higher Monday, even as public holidays in China and US contributed to thin trading conditions. While new COVID-19 variants are threatening to temper the outlook, investors are banking on US government spending and the coronavirus vaccine rollout to boost the economic recovery. Underline, investors are banking on U.S. government spending. This insane operation of spending on steroids from the fiscal policy side and the unlimited tsunami of liquidity from the monetary side, which I call the cocaine. It's the cocaine operation. What is the cocaine? Fiscal and monetary liquidity. It is fueling speculative activities not just in the equities market, but also in the commodities market, leading to higher inflation in copper, platinum, grains, lean hogs, softs, you name it. But there is also a macro reason for the surge in commodities prices. For example, we know that the Federal Reserve and the federal government's policies of easing financial conditions led to a massive surge of home buying. People went bananas. They've experienced FOMO, buying homes left and right due to the low mortgage rates. And now we have reports, by the way, that they regret their decisions. These zombies who stampeded to buy homes by the donkey mentality. Buy first, ask questions later. Matter of fact, don't ask questions at all. What happened is that they have overpaid for these houses, and some of them didn't even bother locking the low mortgage rate. And now, as we see yields surging higher, perhaps mortgage rates will follow through, and all of a sudden these people will find themselves buried alive. We will have a massive housing crisis. All of this stampede in buying houses led to the surge of prices in lumber, timber, and other home building commodities, let alone the uneven recovery globally, where we saw Western countries struggling to defeat the virus, meanwhile Asian countries, specifically China, defeating the virus successfully and normalizing the economy a lot faster and sooner, leading to a surging demand from China. And this is, by the way, from 2018, so the share of Chinese demand for all of these commodities have risen since then. But I'm just giving you an example here. China commands about 47% of the entire aluminum supply globally. Similarly, 56% of nickel, 50% of copper, 47% of pork, 23% of corn, and 33% of cotton. So China has recovered faster, and they are hoarding these commodities. Meanwhile, the suppliers of these commodities, such as the United States, Brazil, Russia, etc., they're still fighting the shutdowns from the virus, leading to lower industrial output and lower supply of these commodities, leading to the demand to surpass the supply significantly. And this is yet another reason why we're seeing a massive surge in commodities prices and therefore a surge in inflation expectations. Here is the 2020 price performance for agricultural futures, specifically hogs futures in China. The prices are skyrocketing. Furthermore, what about metals futures? Massive surge higher, whether we're talking about aluminum, copper, zinc, nickel, lead, tin, all trading way above the pre-pandemic highs. Similarly, you can see that the iron skyrocketing higher to levels haven't been seen in many years. And now we have an energy crisis in the US, not just due to the deep freeze in Texas. That was just the nail on the coffin. Oil prices have been rising consistently since the election of Joe Biden. Of course, under the expectations that the Joe Biden administration will taper the domestic supply, leading to a surge in oil prices globally. And now we have the deep freeze in Texas, and you see oil prices pretty much recovering their pre-pandemic levels. And here's what's going on regarding the deep freeze hitting the United States right now. Natural gas prices soar amid freezing US temperatures while oil hovers at January 2020 highs. Natural gas at one US trading hub went for $9.99 today versus $4 last week. Massive surge. The natural gas market is experiencing some of its most chaotic conditions ever. There's a crisis going on in Texas right now, and this is just the beginning. You have to assume that all of the pipes that are being frozen right now in Texas will have to be repaired. Similarly, all of that snow accumulating on the rooftops in Texas. Remember, this is not Minnesota. It's not a northern state that is equipped with handling such conditions. We could see collapse in rooftops that will lead to more death, but it will also lead to more reconstruction efforts and demand on these commodities that are already skyrocketing higher in prices that will lead to more and more and more inflation. Oil prices climb as deep freeze shuts U.S. wells, curbs refineries. So on top of the surge of food prices, now if you have to go to work, you gotta pay more in gasoline prices, further tightening the chokehold on the throats of the poor and the middle class in this country. And now that the oil crisis have morphed into a natural gas crisis that is also affecting the industrial output and the manufacturing output, which will lead to lower supplies and higher prices for vehicles now. We're talking about Ford. Ford is shutting its Kansas City assembly plant that makes its best-selling F-150 pickup because of a shortage of natural gas caused by winter weather hitting much of the country. We know that the demand is still high for these pickups, and now that the supply is already under pressure from the chip shortage, add to that the natural gas crisis, and you will have a massive shortage in supply, leading to a surge in these pickup prices. Vehicle prices will surge higher. And what about all the green energy efforts? Are they a perfect replacement to coal, gas, and fossil fuels? Not so far. Matter of fact, they're using fossil fuels to produce all of these energy initiatives, and I posted many articles exposing to you how the proliferation of electric vehicles is not good for the planet as of right now, because producing cobalt, lithium, and nickel produces a massive amount of waste that gets dumped into coral reefs, and the production itself uses a massive amount of water, let alone fossil fuels. But the propaganda goes on because we have a big green energy lobby now, EV lobby, and we know our politicians, the likes of Nancy Pelosi, are gambling on Tesla options, of course manipulating the policies to be favorable for the companies they're buying coal options on. But here's an illustration to how imperfect all the green energy initiatives that we have right now. And this was a clear reflection that fossil fuels are not dead, not even remotely. And this is the reason behind the surge of energy stocks today. We will see a continuation in that surge. Frozen wind farms are just a small piece of Texas power woes. Here's a picture of a frozen wind turbine. A helicopter running on fossil fuel spraying a chemical made from fossil fuels into a wind turbine made with fossil fuels during an ice storm is awesome. So much for green energy. And here it is, wind turbine blades cannot be recycled, so they're piling up in landfills. And of course, the only solution right now is nuclear energy. That's the only sufficient green energy choice. And here's a perfect take for the rise of energy stocks and the energy sector in general. When you pin the XLE versus the XLK, the XLE is the energy ETF, the XLK is the technology ETF, you can see that since the bust of the dot-com bubble, energy stocks and the energy sector in general outperformed the technology sector until the global financial crisis, where we saw technology outperforming energy significantly. And now we're bottoming, and perhaps we're reaching an era where energy will outperform technology once again. So this is a very, very important take, and it is an illustration to the changing geography of investing in the stock market. The generation of investors who are used to buying technology names, they think that this is the future, bro, and this is how the stock market works. Just invest in technology because it's the future. Be careful here, because the macroeconomic outlook is changing the investment terrain in the stock market, where cyclicals, financials, energy, industrials, materials are set to outperform the technology and the growth sector. And now that I have illustrated for you the horrific picture of inflation, whether we're talking about food prices, whether we're talking about energy prices, oil or natural gas, whether we're talking about metals and copper in specific, the picture could not be any clearer that inflation is skyrocketing as we speak. And here is the result. Global stocks are having the longest run of gains since 2003. However, treasury yields are hitting their post-pandemic highs. So market participants continue to put their blindfolds on and continue to buy in the stock market, even though treasury yields are surging significantly. It's only a matter of time. There is a magic number here. Once we hit that magic number, the algos will start the tsunami of selling. A lot of people will find themselves caught with their pants down. The gap between the 2- and 10-year treasury yields is the widest in almost 4 years, once again illustrating the changing topography in the stock market. And I will let economist Mohamed Al-Arian explain to you how the Fed is between a rock and a hard place. They're very confused and they have no clue what they're supposed to do right now. They wanted inflation to rise higher. Well, inflation is rising and skyrocketing, matter of fact, but they continue to deny it. They continue to brush it under the rug because they know that the unemployment picture has not recovered yet. And all of this is going to lead to a stagflation and a rise in treasury yields, which in turn will destroy the stock market.
Advisor at Allianz, who's the president of Queen's College at Cambridge University. Mohammed, fantastic to have you on the show as always. You know, the data that surprised me and probably shouldn't have done in the past week was the inflows into equities. $58 billion and to illustrate the liquidity phenomenon. Bonds also $13 billion of inflows. What do you make of that at this point in time?
Thanks for having me, Julia. What I make of it is that investors are chasing what someone labeled the rational bubble. Investors know that asset prices are very high, but there's reason to believe they'll go even higher. Why? Because in addition to massive central bank liquidity injection, there are real prospects of massive fiscal injections on top. So basically, investors feel confident riding what is a massive historic liquidity wave.
Do you buy the relatively muted inflation data that we got on Friday, or do you share the concerns of those like Bill Dudley, the former head of the New York Fed, who said, look, there are a number of reasons to worry here. One, the recovery is going to be faster than we think. Corporates have cash. Individuals, by and large, have cash or will be getting some more. And people believe inflation will rise. How concerned are you?
So I think we're going to see the price level change by more than what the Fed is expecting. Where there will be a massive debate is that an inflationary process, or is that a once and for all increase in price level as we reopen? What's interesting is the market may not wait for that. And that's the concern out there, that when the market sees the price level go up by more than what the Fed is expecting, they will worry. And already you have seen bond yields on longer dated securities go up. So there is concern, and you're starting to see it in the marketplace.
Because there's a timing mismatch there. You can have, fueled by all the liquidity, the hopes for reopening, vaccines flooding the market, recovery theme driving stocks. And even before you see the whites in the eyes of inflation, a reaction to all of that in the bond market.
Yes, absolutely. I mean, there's two timing mismatches. One is in the real economy. Economists make a difference between notional demand, what we'd like to do, and effective demand, what we are able to do. And right now, our notional demand is much higher than our effective demand. We can't travel. There's a whole host of things we can't do. So as we reopen, our effective demand goes up to notional demand. So there's a lot more demand in the economy, but the supply may not respond as quickly. That's the first mistiming. The second is that bond prices start to move before actual inflation. They move on the expectation of inflation, which would put the Fed in a really difficult position. What does it do? Does it let yields go up and risk equity market disturbances that then feed back into the economy? Or alternatively, do they get pulled in even more in intervening and distorting markets? That's not a great position to be in.
But what do you think? Which one?
I think they'll be tempted to do the second, because that's what they've been doing all along. And they'll hide behind we got to give this economy every chance. But the more you distort markets, the more you distort asset allocation, the more you reduce efficiency and productivity. So this is not a costless exercise. There is a lot of collateral damage and unintended consequences.
I mean, we should talk about the people that get left behind and the fact that it does, whether you like it or not, exacerbate the inequality that we see in society and keep talking about trying to address. But in the interim, we make it worse by trying to support more, a further support for the sort of weakest part and element of the economy, as we quite rightly should do. I'm struggling to compute the everything rally that we seem to be seeing here, with signs, classic signs of a market top, froth in the IPO market, fundraising going gangbusters. Can we continue to see both of these things for a significant period of time, simply because what we're seeing now in terms of stimulus is so unprecedented?
So we can, unless one of two things happen. One is a market accident. And I think people don't sufficiently appreciate how close we got to a market accident a few weeks ago with Reddit, Robinhood, and certain stocks. We came very close to a market accident. And it would have had what is called contagion. It would have contaminated other things. So the first danger is all this excessive risk-taking becomes irresponsible risk-taking, and you get a market accident. The second risk is the bond market. that if you destabilize the bond market, you take away two reasons why people are so keen on stocks. One, this notion there's no alternative. Well, if yields go up, there is an alternative. And second, this notion that with yields that low, floored forever, discounted cash flow models signal buy for equities. So that's the two risks that a lot of us are monitoring, but getting the timing right is really hard.
And this is a perfect point to segue to some Fed news. You saw what happened to Treasury yields today. Massive surge higher, and you are now aware of the explosion in inflation. Prices are rising higher by the day, choking the average American household. So what is the Fed doing to combat inflation and tamper inflation expectations? Are they being honest? Are they conducting any policy changes? Of course not, because doing so will freak out the stock market, and that defies their main mandate to prop up and inflate the assets of the wealthy, stocks, and real estate. In fact, all of what they're doing right now is releasing their propaganda tour, starting with the master of propaganda, the master of deception, St. Louis Fed President James Bullard. We have talked about this guy in details before. He is completely out of touch, and he lets the hash he's smoking speak for him. And we're not talking about the regular hash that me and you are smoking. We're talking about the Fed's hash. This is the good stuff. And of course, James Bullard, I will just give you examples of how insane this guy is. He's a total clown. He has no rationale whatsoever. Last year, he said that the recession lasted for only 2 months, and now we are over and past the recession. He also predicted that we will reach full recovery by Christmas, and we now know that this was all bullshit. And of course, he goes onto television and he lies to his teeth, and he cannot even believe his own bullshit. I don't know if you caught the interview in the morning with CNBC, but he almost lost it. He almost started laughing at his own bullshit. I don't know what's wrong with this guy, what kind of stuff he's smoking, what kind of stuff he's drinking. And I'm not going to waste any time showing you the entire video, but I'm just going to give you a little sample for you to understand who James Bullard is.
And do you yourself, have you bought any Bitcoin?
I don't. I actually can't invest. I only invest in indexes and stuff. Currency competition has been going on forever. The British pound in the 19th century was the top dog. Was replaced by the dollar in the 20th century. Still the top currency, but it is a currency competition. And
once again, either he's high or drunk or perhaps both, but this doesn't look like a rational guy with any awareness whatsoever. And here is some of the bullshit he spewed today. Fed's Bullard: we are in a good shape with inflation right now. Are you kidding me? Fed's Bullard says equities are not in a bubble. It is just normal investing. And he said that with a straight face, by the way. He was more from Bullard. There is no reason to get ahead of ourselves in tapering. Of course, there's no reason. You will never taper. This is the cocaine operation. The market is a cocaine addict. And you know that any tapering in the cocaine operation will cause the market to suffer a withdrawal. And of course, the Federal Reserve is not interested in that, because their main mandate is to protect, preserve, and inflate the assets of the wealthy. They are never going to upset their overlords without getting permission first. It was more from Bullard. Bitcoin poses no threat to the dollar as the world's currency leader. Okay? And it was more from the propaganda tour from the Federal Reserve. Fed's daily pressure on inflation are downward. And they're saying this with a straight face, by the way. They're not even trying to pretend that they're not bullshitting. Too high inflation isn't a risk to think about at the moment. This is like the dinosaurs looking at the sky and seeing the giant asteroid and then telling each other, oh, the asteroid is not to worry about at this moment. Let's wait till we die and go extinct, and then we'll worry about the asteroid. There's more from the Fed's bullshit. Doesn't see unwanted inflation around the corner. How do we start? Do we even need to start at this point? I just outlaid every single fact for you, from energy prices, natural gas prices, commodities prices, grains prices, food prices. Every single fact is pointing to a surge, a massive one, in unwanted inflation. And these morons think that they will deceive the market somehow if they continue in their propaganda tour by denying, hoping that the market will buy their bullshit. All you have to know is watch the 10-year Treasury yield. The market is saying, no thank you, we are aware of what's actually going on in the economy. Moving on to sentiment news, starting with the whole crypto mania. And here it is with Dogecoin. Dogecoin co-founder says he cannot comprehend calls for the joke crypto he created in 3 hours to hit $1. And they provide you with a picture of this guy. This is what he looks like. Here is more for Dogecoin. Dogecoin drops after Tesla's Musk supports holders selling most of their coins. Of course, Reverend Elon was pumping Dogecoin, and now he's supporting the holders to dump their shares because he doesn't want any concentration from few holders. He's not even trying to pretend that he is manipulating Dogecoin prices. And here's the result. The cryptocurrency Dogecoin was created for laughs, serves no purpose, and is now worth more than Western Union, Under Armour, and Xerox holdings. I hope that Bullard and the Federal Reserve are proud with this joke of a market that they have created. It was more in market sentiment. Gold, silver funds see biggest weekly outflows in 3 months. Why is that? They're dumping gold and they're buying Dogecoin instead. I hope that Jerome is very proud with the market conditions that he created. Quote-unquote market functioning. The whole market became a parody, a joke, for laughs. Here is more illustration of the zombie mentality and the morons who invaded the market as of late. Many dum-dums are suggesting buying Bumble stock to quote-unquote support women. And here's what I said. If you want to support women, donate to the women janitors and housekeeper maids who lost their jobs and are waiting in food lines to feed their families. And by the way, some of those janitors and housekeeping maids happen to be illegal, undocumented, and they cannot apply for federal aid. So they are literally on the brink of starvation. So instead of pouring your money buying the garbage that is called Bumble, which by the way will crash just like GameStop, how about you donate your money to women who are suffering right now and actually need your money? And this lady Bumble founder, Whitney Wolf Herd, which is a perfect name to what's going on in this market, because this wolf is about to slaughter the moronic herd once she's allowed to dump her shares. And by the way, Whitney Wolf, her father was a multi-millionaire and her husband is an oil tycoon heir. She doesn't need your support. But this is the kind of stupidity in current market sentiment. And perhaps here's a lesson for you Bumble investors. A 25-year-old security guard was so enthusiastic about GameStop stock that he took out a $20,000 personal loan and used it to buy shares. Now his investment is down nearly 80%. Other small-time investors have lost big too. And the mania is not exclusive on the retail side alone. Even institutionals are participating in the mania and losing their mind completely. Here's the Bank of America buy-sell indicator regarding cash levels. When cash levels drop below the red line that you see right on the chart, we are entering a sell category, meaning that the mania has reached extreme levels, and this is not a buyer's market. Oh, but what about corporate earnings? Corporate earnings are coming out excellent, and they're offsetting the overvaluation in the stock market, right? Wrong. Here's the S&P 500 EPS growth year over year. We are still down 19% year over year. There is no growth here. The only growth is related to FOMO and the mania of buying regardless of what the fundamentals look like. What about the SPAC mania? It's getting comical by the day, to the point where SPAC managers have no shame anymore. Here's another filing for a new SPAC called Just Another Acquisition Corporation. We know about the Laugh My Ass Off SPAC, and we've heard about the Queen Gambit SPAC, so why not? The whole market is just a video game. But there are warning signals going on as we speak. The VIX futures curve continues to steepen. Traders are betting on much higher volatility in May, meaning that we already know that we are sitting right now in a sinking Titanic. And we know the inevitable is going to happen. We're going to drown to death. But we're still taking chances, rolling the dice to squeeze the last bit of juice, and everybody thinks that they will time the market perfectly, that they will be able to hop in the lifeboat before the Titanic sinks. We'll see how that one works out. And here it is perhaps the clearest illustration of the extreme mania going on in the stock market right now. The only reason to be bearish is there is no reason to be bearish. Bank of America Fund Manager Survey. The survey shows global growth expectations at all-time high, cash levels at 8-year low, equity and commodity allocations at highest since 2011, and only 13%, I repeat, only 13% say it is a bubble. And according to the same survey, 100% of those managers surveyed have missed their eye doctor's appointment. And what do you do when you see all of this greed going on in the market? Perhaps it's a good time to remember a quote from the greatest investor of all time, Warren Buffett. Be fearful when others are greedy, and be greedy when others are fearful. And perhaps this is a good time to segue to Berkshire Hathaway and what the big buffet, Warren Buffett, have bought and sold from the latest disclosure. And the point here is to see where the sentiment for Warren Buffett is. For example, he trimmed his General Motors shares after the massive gains. He trimmed his Wells Fargo shares further, and he got rid of JP Morgan Chase, and he got rid of Pfizer. Meanwhile, he's adding to value names. Berkshire Hathaway ups drug stock stakes while trimming Apple. They're getting rid of the mania names, and they're adding to value names. Berkshire increased its stake in AbbVie by 20%, Bristol Myers by 11%, and Merck by 28%. Notably, Berkshire trimmed its stake in Apple by 6% to just over 887 million shares. Other big moves by Berkshire included more than doubling its stake in T-Mobile to 5.2 million shares and a new 146.7 million shares, and this is a stake in Verizon, in addition to a new stake in Chevron and hiking their stake in Kroger by about 34%. These are all names that yours truly in this channel has been advocating for months now. We've been talking about Kroger. We've been talking about AbbVie, T-Mobile as being one of my top favorite names, and I own some of these names already in my portfolio. And it seems that the big buffet also agrees with me, although I think it's the other way around. I agree with Warren Buffett, not the other way around. Even though I did talk about T-Mobile before Warren Buffett even disclosed that he has a stake in the name. But once again, great minds think alike. I have been a student of Warren Buffett's work, and I can spot the same names that he is also spotting. Moving on to corporate-specific news. What do we have here? How about General Motors? GM released more information about the new Chevy Bolt, and it is now a compact SUV with 250 miles of range and hands-free driving. And they provided some details regarding the pricing, which will start at around $34,000. It's a beautiful car, but it is pricey at the starting point of $34,000. The whole point is to compete against the Tesla Model 3. At a starting price of $34,000, the advantage is very, very slim. And what about Apple? The search continues for the new iCar. We heard the fake news regarding Kia and Hyundai manufacturing the new iCar. They threw cold water right away in the news, and now we know that Apple is still searching. Apple reportedly approached Nissan about making an autonomous car together, but the talks collapsed after they clashed over branding. I don't understand why Apple is working with Nissan. Nissan is known for their shitty quality. They have lost the reputation they used to have back in the 80s and 90s, and now they produce garbage cars. So why is Apple interested in using Nissan to produce the iCar? How about using a reputable and reliable car manufacturer to do the job, such as Toyota or Honda? Or is Tim Apple and Co. just playing games, trying to prop up the stock higher by giving us the illusion that there is an iCar when they're actually not planning at all in producing an iCar? Remains to be seen. But here is more in EV news. We heard from Jaguar, and they told us that the brand will be an all-electric brand from 2025. So every Jaguar is going to be electric by 2025, and they are aiming for net zero emissions by 2039. And the EV war heats up by the day. Moving on to the heat map analysis, let's see what happened today and if we can figure out a specific theme that took place in the market. We continue to see the surge of chip names under the enthusiasm that the Biden administration will issue an executive order to fund building factories for these manufacturers. We saw continuation of the gains for names like AMAT, Applied Materials, Lam Research, NVIDIA, Taiwan, Intel, but notably the decliner here for the day in the chip sector, AMD down about 2.5%, along with Xilinx also down about 2%, and Marvell Technology down about 1.5%. So a little bit of softening here in the sentiment. We saw the FOMO rush last week, and now perhaps they overdid it. We will see some outflow from chips, perhaps as soon as we get the news from the Biden administration that they're not going to throw billions and billions of dollars of free money on these companies. What about big tech? Any theme here? Google and Facebook continue to outperform, but notably Amazon, Microsoft, and Apple continue to underperform. And remember, the underperformance from Apple is very, very notable. As Apple go, so will the market. Apple is the leading indicator. We also witnessed some earnings reactions, such as Palantir. Palantir was down big, double digits. We also saw Salesforce gaining significantly, closing about 3.5% for the session. What about the communication services sector? Muted activities across the board. But we continue to see gains in some momentum names such as Spotify, DoorDash, Twitter. Zoom is rising from the dead. It is all done via call options buying here. But the party in Zoom is pretty much over. It is not the hot name it used to be before. What's going on in cyclicals? We saw a bid for the nostalgia names / the reopening names. As we continue to hear more about the success of the vaccine rollout, we see gains in cruises. Carnival Cruises up over 9%, Royal Caribbean almost 10%. We saw gains in hotels, casinos. Las Vegas Sands was up over 2.5%. Gains for the airlines. Delta closing up over 3%. And of course, the surge in commodities pricing is helping the inflationary trade. We are talking about materials such as copper. You saw massive gains today for Freeport McMoran. The name was up over 5% for the session. Similarly, we saw gains for steel names. Energy names, ExxonMobil up over 3%. Chevron was also up modestly during the session, but after the disclosure that Berkshire Hathaway bought a stake in Chevron, we saw the name rallying higher after the bell. Massive gains across the board in the energy sector. Take a look at BP up over 5.8% today. We also saw some cyclical names, inflationary names such as Caterpillar, Deere, General Electric, Boeing scoring gains in the industrial sector. And what about the rise in the 10-year Treasury yield that is helping the gains in the financial sector? JP Morgan, Bank of America, Wells Fargo, all closing with massive gains for the session. Regional banks, PNC was up over 4%. U.S. Bank Corp up over 2%. We also saw gains for Morgan Stanley, Goldman Sachs, Charles Schwab. Massive gains for Schwab the last few days. Today, the name was up almost 5%. So all in all, the theme remains the same. The inflationary trade is the dominant theme in the market right now, in addition to the semiconductors trade due to the chip shortages. Moving on to the charts analysis, starting with the SPY 15 minutes chart, gapping higher and then flushing down and consolidating in a bear flag pattern. We talked about the scenario that we will see the top in this market in a gap and crap scenario. So the question is this it? Is this the top for the market, the gap and crap? I wouldn't say that. We're just looking at a 15 minutes perspective, showing a bear flag, and the gap and crap was not that significant. I am talking about a scenario when we wake up and we see the Dow Jones skyrocketing 400, 500 points and then flushing down, closing in the red by 200-300 points. That would be the ideal gap and crap scenario. For now, all we know, this is a mini gap and crap for today's activities alone, which happen to be under low volume. We are in a shortened week of trading after all. So from a 15 minutes perspective, we are seeing a bear flag that should take us lower. However, shifting to the big picture and looking at the daily contract for the SPY futures, we are still consolidating in what? A bull flag formation that is supposed to take us higher. And you have to differentiate between the shorter term charts versus the longer term charts. The 15-minute chart is bearish, but the daily chart remains bullish until and unless we do what? We break the support of 3,862. That will put the bull flag theory to rest and will open the door for a correction in the market. Shifting to the Qs, the Nasdaq 15 minutes chart. Similar story here, a gap and crap consolidating in a bear flag pattern that is supposed to take us lower, at least to go back and retest the trend line for support. But remember, this is only a 15 minutes chart. So let's zoom out to the big picture and visit the daily chart for the continuous contract for the Nasdaq. Once again, as we saw with the SPY, we're consolidating in a bull flag formation. We're above all the support levels, all the moving averages. There is nothing bearish here in this chart beside the slight negative divergence in the RSI. But if we see another green day, we will see a recovery in the momentum as well. And for those conservative traders who want to look for a solid confirmation of a reversal in the Nasdaq, take a look at the continuous contract in the big scheme of things. We are trading in a channel that's been going on since pre the pandemic crash. And we have not broken this channel to the downside at all. We're trading in the middle. We can go higher, we can go lower, but you're not going to turn bearish on this market until you break the lower end of the trading range. This is, of course, for those who are looking for a solid confirmation. But professional traders and people who are thoroughly aware of technical analysis will spot the reversal ahead of time, and they will start shorting the market as soon as we see a solid reversal signal. What about small caps? The IWM 15 minutes picture. Once again, gap and crap consolidating in a bear flag formation that is supposed to take us lower. But once again, we are trading above all the critical levels. Let's zoom out to the daily chart. We're trading above the moving averages. We're trading above the upper limit of the trading channel. We're trading above support lines, and we're just consolidating in a bull flag formation. Until and unless that is negated, the chart remains bullish. How will it be negated? Going down to close some of these gaps and not bouncing higher. Furthermore, take a look at the RSI. Breaking the trend once again will signal a weakening in the momentum, and we're getting very close here to lose the momentum throughout this rally. It goes all the way back to September of last year. We've already broken it once, and I told you that once you do that, the damage is already done. And it is a headless chicken running around, and it is just a matter of time before you see a correction in the IWM. But for now, looking at the chart as it is right now, it is still consolidating in a bull flag formation. Once we break the RSI to the downside, once we reach some of these gaps and we don't bounce higher, that would be your confirmation that it is worth it from a risk versus reward perspective to place a short on the IWM, perhaps by buying the inverse index, the TZA. What about the RUT, the Russell 2000? Once again, consolidating in a bull flag formation. Nothing is bearish right here. Slight negative divergence in the RSI, but we don't have a confirmation whatsoever for a reversal. Moving on to the dollar index, the Dixie. What do we see here? Last time around, we talked about a bear flag formation, and we saw the Dixie going lower earlier in the day until we received the Empire State Manufacturing Index, and that caused the dollar to rise higher and gold to flush lower. And this has done a massive damage to the bear flag outlook, because take a look at the RSI. We are recapturing momentum here once again. We're curling upward. Perhaps the dollar, per usual, as I call it, Tricky Dixie, is playing another bear trap, where it is playing possum, showing you a bear flag consolidation, failing to capture the level of 90.5, sucking a lot of shorts in, and then reversing and trading higher once again. And we know that the level of 90.5 was recaptured once again. So the dollar is being very volatile here and playing a lot of tricks. Once again, the dollar will be extremely volatile, and tricks will be played, shaking out the weak hands. Tricky Dixie played a bear trap last week, sucking a lot of shorts last week before squeezing them today. And perhaps Tricky Dixie is pulling another one by creating a bull trap this time around, because others will assume that the dollar index will rise higher now. Since we have defeated the resistance level of 90.5, they will go along the Dixie and then they get slaughtered tomorrow if we see another trick from the dollar index. For now, we are a spectator of what's going on regarding the dollar and gold. Speaking of gold, let's take a look at the chart of gold. We talked about a bear flag for the Dixie, and we talked about a bull flag formation for the dollar index. But over the weekend, you saw the bull flag formation being flushed down the toilet because we saw massive declines here for the dollar index, breaking the level of support of 1800. And this was a very critical level of support to be defended. Now, we talked about the rise of inflation. And a lot of people are still confused. Why isn't gold rallying if inflation expectations are rising higher? The reason is Bitcoin is stealing the thunder from gold. Until you see a crash in Bitcoin, my assumption is gold will continue to underperform. And what about the TNX, the 10-year Treasury yield? We talked about the ABC pattern, and we talked about the bull flag consolidation, and now we have a breakout closing above the critical level of 1.26. Matter of fact, closing at 1.3, a massive surge overnight. In one day, the TNX surged from 1.20% to 1.30. And if we continue to see the same velocity of the move, it's not about a number, 1.5, 1.8, 1.4. That doesn't matter. We know there is a magic number, and the consensus is 1.5. However, it is about the velocity of which you're going to reach that number. If we continue to search tomorrow and we see 1.35, 1.40, you bet that the Federal Reserve will start shitting their pants. And they will release more and more propagandists and mouthpieces to spew misinformation and misleading manipulation attempts. For now, they're failing and failing and failing. We will see if they have another trick here to whack yields in the head and drive them lower, at least for temporary basis until they reassess and reflect on their policies. What about the VIX? The VIX surging higher today, about 7% or so, even though we did not see massive declines for the equities markets. But I showed you the yield curve, the VIX curve during the headlines of the day segment. And a lot of traders are betting on a market crash in May. That usually happens earlier because traders are more conservative in their estimates. They like to go a little further in time. So when they expect a surge in the VIX in May, it is likely to happen a little earlier, in March or April. There's a lot of enthusiasm from the Perma Bull side, the Tom Lee side, and the likes about the VIX going under 20. That would be a massive signal for market rally. For now, the VIX is saying, I'm not ready to go under 20. I'm just trying to trick all of these bulls, suck them in to believe that there is another leg for the rally and then slaughter them. The market is very, very dangerous right now. You're seeing a bull flag formation happening in the NASDAQ, the IWM, the SPY, and you're seeing bearish consolidation in the VIX. The assumption here is that the market is going to rally higher, but that could be the ultimate bull trap. You gotta be extremely careful here. I maintain my position. My opinion is the VIX will surge higher. Before the VIX goes under 20, there is another surge higher. I maintain my position. What about Apple? What's going on here? We continue to talk about Apple as a leading indicator, a canary in the coal mine. Apple struggling to close above 138, which will be the confirmation that the series of higher lows, the bullish trend goes on. Breaking 131, this is the level of support, would signal that the bear flag formation is playing out and the bullish trend in Apple is coming to an end. And as Apple goes, so will the market. Always remember that. Moving on to Tesla, what do we see here? A down day for Tesla, down about 2% or so, and we have broken the support of 800. We saw the level of 800 being defended last week. This time around, they closed at 796.22, failing to defend the 800 level. That in itself will open the floodgates to go down to 780, 750 until we find a bid, until the name catches a bid. It is a bidding process, going down to 750. Any buyers, any takers? If not, we're going down to 700. Any buyers, any takers? No takers? All right, we go to 650, then 600. And of course, the level of support here, the critical one, is 599. Tesla's chart is pretty much dictated by the psychology and the action in the options market. The retail side is not so enthusiastic about Tesla anymore. They have other shiny objects in Bitcoin and other cheaper stocks to trade. Tesla is very expensive right now. The options are very expensive, so the trajectory here is lower until we see the name catching a bid. Is there a magic number from which traders are going to buy Tesla and support it? For me, the number is 599. I'm not going long Tesla unless we go to 599 or we catch support from that level. For now, my puts remain on the table, and I do maintain that the trajectory for Tesla here is lower until we see call options buying surging again. Moving on to conclude this video, you're starting to sense that the market is paying more attention to the move in the 10-year Treasury yield. We've been talking about this over and over and over again. The market has been ignoring the threat of the rise in the 10-year Treasury yield. Today we saw a reversal. in equities from the highs, as we saw Treasury yields surging higher. Furthermore, the media is talking about it more. The Federal Reserve is starting to look a little nervous, sending Bullard out to make an asshat out of himself on national television. And if we continue to see Treasury yields surging higher to the same magnitude we saw today, we're getting closer and closer and closer to the panic scenario where we will see a significant correction in the overall market, specifically in the NASDAQ and the growth sector of this market. So the number one chart to watch here is the 10-year Treasury yield. We will watch it overnight and see how high it's going to go and how the Fed will try to manipulate the market, because going to 140 tomorrow will cause a panic in the market. Guaranteed. The algos will start to freak out first. Of course, we're anticipating how the Fed will try to bullshit their way out of this one. Anyways, that's all I got for you tonight, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.